Cashflow Chronicles. It is your boy, Maddie Moolah. Cashflow Chronicles, what is this, number 38. Excited to be back. Excited to talk about PayPal. Excited to talk about what Papa Jerome was talking about on 2 o'clock p.m. Eastern time today. So curious to see what we can kind of get ourselves into. Chris is likely to join us in just a little bit. I sent him the link, so he might just be running a bit behind. But what I did want to kick off with is looking specifically at some of the things that have been going on in the markets today. Obviously, Jerome talked a little bit, and so that was a big piece of it. But then there's some other things in the news, specifically Disney, specifically PayPal, that I want to dive into, and a few other companies that reported today. I did watch Jeremy's live stream on Twitch, and he brought up a bunch of different companies that reported today. Cheesecake Factory, Elf on the Shelf, a few other companies as well. Enphase is down big again today. You have a lot of companies that are starting to still feel the impacts of the interest rate hikes that are kind of going on right now. And so with that, of course, it's pertinent to kind of understand what Jerome is talking about and how that's going to impact this going forward, because obviously that has a huge implication on the slowdown of some of these companies. Revel as well was another one that Jeremy has in his portfolio that was also down big today as well. So without further ado, let's just kind of kick off one of the pieces that Jerome Powell started off with in the Q&A section in his conference today, and see what he has to say.
Just a quick question following up on an earlier one.
Let me know if you guys can hear that.
With regards to the Israel-Hamas conflict, the Fed's financial stability report said the Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade in food, energy, and other commodities. You've had organizations like the World Bank warning of a possible surge in oil prices if the war spreads to other countries in the region. I'm just wondering how the Fed is monitoring these developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region. Thank you.
I wouldn't want to speculate too much, but I'll just say so. Really the question there is, does the war spread more widely, and does it start to do things like affect oil prices in particular, since this is the Middle East we're talking about? The price of oil has really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects, and it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important and something for people to take great, really important notice of, but it may or may not turn out to be something that matters for the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. The war in Ukraine, did have immediately.
So I think this is pretty important because a little bit about what is going on in the Middle East, as well as kind of Ukraine and stuff of the like, is actually starting to take hold and be a part of what the FOMC is kind of looking at, which is kind of counter what the folks in the FOMC have talked about in previous months and previous meetings. They say, oh, well, you might be hearing about this or that in the news, but in reality, all we're looking at is the economic data that's coming in, right? That's stuff that we always talk about, the CPI data, the core CPI data that comes in, which generally speaking has a little bit of lag to it, right? So I think that this is a little bit of a thought process that is kind of new. And another piece is that they are looking at some of these more recent trends, which is something that is kind of unbeknownst to them in more recent times. So I think that's something to kind of consider now that you're kind of seeing that come through. Now, I'm curious, Tom Lee, those of you guys that may or may not like him, talked a little bit today as well. And so I just want to pull him up and see what you guys have to say about this
number. So you think they're going with the gut? If they're not going to be data dependent entirely, are they just going with all the fields or what?
Well, that would allow them to look at the move in long-term rates and say that's 4 hikes, and that allows them to be patient. And then I think as long as inflation expectations are anchored.
Let me restart it.
Let's bring in our panel. Fundstrat Global
Hi,
Advisors
Tom.
Managing Partner, Mr. Tom Lee, and Senior VP at Morgan Stanley Private Wealth Management, Caterina Simonetti. Caterina and Tom, thank you both for joining us. Caterina, the market seemed to like it, didn't love it, sort of a strong like, if you will. Should it have, or did we misread it somehow from the Fed today?
Well, Brian, today's pause by Federal Reserve was highly anticipated by the market. Rates on bonds have been going up for the last couple of months. So in essence, the bond market has been doing Fed's job. And in their statement today, the Fed did mention the tightening credit and financial environment, which pushes the cost of borrowing both on credit cards and on mortgages and of course on corporate loans, and is having a profound effect on the corporate and consumer confidence. And it's only the matter of time that is going to be translated into earnings. And while Fed might be done raising rates, we're not quite at the point where they're ready to cut yet. And this means that this narrative of higher for longer might be here to stay.
Tom, if the Fed is, or the bond market is doing the Fed's job, then what is the Fed's job? Like if the bond market is moving yields around, why has the Fed, until today, continued to aggressively raise rates? If to Caterina's point, the bond market knew this was going to be the path.
Well, I think today might have been the first press conference where the Fed is shifting away from data dependence. Because
explain.
Well, a couple things came up. One was a question about, hey, you mentioned inflation expectations jumped, and Powell was quick to dismiss it and saying, look, a lot of other surveys show inflation's in a good place, expectations. And then the question came up about, above average growth. If the Fed was data dependent, they'd be wanting to sort of push that down, but they said they can see labor supply dynamics driving that. And thirdly, they noted progress on the PCE report from last month. I mean, that's a forward-looking view because on an absolute basis, that's still a hot number.
So you think they're going with the gut? If they're not going to be data dependent entirely, are they just going with all the feels or what?
Well, that would allow them to look at the move in long-term rates and say that's, 4 hikes, and that allows them to be patient. And then I think as long as inflation expectations are anchored and businesses don't pass on price increases, I think inflation is going to cool pretty quickly.
Caterina, in 1994, the Federal Reserve raised interest rates 2.5%. We call it 250 basis points.
So I thought that was pretty important to kind of look at as well, because, like I kind of alluded to at the first clip where we're talking directly to Hot Jerome and, the guy who's heavy on the gas pedal, he was kind of looking at the Middle East and the conflicts in the Middle East to say, these are things that are going on currently right now. These are things that are particularly driving the markets. Kev, let me just get you a wrench here. And these are things that we're kind of looking at, right? Whereas before, and many times, things like that, we're not really taking into consideration. So I think that you're now starting to see a little bit of, I don't want to say backpedaling, because they're still holding their stance. They're still saying, 2.0 inflation means 2.0 inflation. But I think they're taking now a little bit more into the bigger picture of things that are going on in the markets these days, rather than specifically looking at data that's sometimes 3 to 6 months behind. And so I think that now, I did see some other articles out there that I thought about bringing up about how there's still potential for a 50% or 50 basis point hike up, or 25% basis point hike up in December. I personally think that with all the data that's going on right now, with the way that things are going right now with the markets, with the conflicts going on in the Middle East, with the conflict continuing to go on in Ukraine, with basically being on the brink of World War III, I think we're going to continue to hold for now, unless there is some sort of runaway data that comes out on the 12th or 13th of this month. If I remember correctly, let me pull up our handy dandy schedule here really quick and to see specifically the Cashflow Chronicles schedule. So on the 14th, on Tuesday the 14th is when we're going to be releasing, or at least I'm not releasing, but the Bureau of Labor and Statistics is going to be looking to release that data on the 14th of November, we'll have a better idea as to what's actually going on for that. So while I have this up as well, before we kick it off into some other clips as well, and before I message Chris in the background to see if he's going to join us today, let's just take a quick look at what we have in store for the rest of the month. So we're obviously going to talk a little bit about PayPal today, walk through those earnings. We can talk a little bit about what Jerome has already said about the FOMC. We've kind of walked through some of those clips as well. And then obviously we have Palantir, Apple, and Accelera reporting tomorrow. Palantir is reporting before the bell. Apple is reporting after the bell. Accelera, I'm not exactly sure. This is a Chris Patel special. He turned me on to the stock a little bit. I don't own a position in the company, but I'm curious to see how it looks. I have heard some rumblings about that. And then, as you guys already know, we do SoFi and Palantir weekly. Hey, we actually have somebody from Twitch joining us. This is pretty cool, but it looks like it's a bot though, so nothing cool about that. And I was also curious if Twitter is working or not, because I did advertise this and try to push this to Twitter. So I don't know how that's going to work, but it is what it is. I don't know if it's just going to say a message like this guy's live or what. But as you guys are already aware, on Fridays we do SoFi and Palantir weekly, so we'll do a little bit more further deep dive, I'm sure, about what's going on in Palantir, what's going on in SoFi. Big week for both, as SoFi reported on Monday. Was that Tuesday? I don't remember. Everything's getting so jumbled up now. My time zones are off and everything like that since I was out for the weekend over in Vegas. Cool. So it looks like we got Twitter up and rolling as well. So we're wheeling and dealing. But next week, rolling in, we have Nintendo, Dutch Bros, Rocket Lab, Disney, all companies. Well, I don't own Nintendo, but I own Bros, Disney, and Rocket Lab. So it's a big 2 weeks. So we got a few folks in the chat here as well. Before we kick off another clip, let's just take a quick look through here and see if there is any chats going on. We got my boy Stefan in the chat. What's going on, my guy? Yes, believe. I'm not exactly sure what flag that is because it just says IL to me. I'm assuming that says Israel, but I just want peace in the Middle East. I don't choose sides, just peace of all kinds. I don't want to get political on here. Yes, we're starting to give out the wrenches to the fair folks that continue to join week after week, day after day. We got Hot Kev in the building, a guy that's been tried and true to the channel for many, many moons. And we got Miss June, as always. Good to see you again, friend. And let's just see what else is here. Yeah, I will be kind of curious to see what continues to happen and unfold in the Middle East and how that impacts the markets kind of going forward as well. And ETF FaceTime handing out beers as always. Yes, you do have the ability to ban people if they start acting up. So that's pretty cool. Okay, so very good. So I did want to look at this as well, because this does seem like, and this was a chat on CNBC as well. It looks like the things that we are kind of observing, the conversations that Chris and I have been having, we've always been talking about when they pivot, you know, when's the time to buy? Not saying right now is, but it was looking like this being the 1st of November, one of the more historical months of the year that ends up being, you know, better for returns and equities, coupling with what's the news in the FOMC world, and then coupling with just the macroeconomic environment getting closer and closer to that inevitable rate cut that's going to be happening in 6 months or so. I would say it's a time to, if you have a lot of cash, potentially start thinking about buying. Now, I don't think that we're necessarily out of the woods yet. You could still see further retracements from here, especially knowing what's going on in the markets as well. I think that there's still some hype in some companies. I wouldn't be surprised to see Palantir pull back tomorrow. I wouldn't be surprised to see a few other companies pull back, but I think it's getting closer and closer to that inevitable point where we start to do a pivot like we were kind of starting to see in the first half of the year. So let's just re-watch this one and see what you guys think.
Our next guest says that the Treasury refunding plan has opened the floodgates to buy all assets. Let's bring in Damp Spring Advisor CEO Andy Constant. So you've been listening to our conversation where we just said this market environment now seems to be a green light for both bonds as well as equities. And that's exactly what you did, Andy, in your portfolio. When did you do that? And how long do you think does this trade last?
Yeah, so Melissa, the first thing I did today was look at the quarterly refunding announcement at 8:30 and found that the bonds issuance for today, for this quarter, was being kept the same. And it's all about bonds, long duration assets that the private sector has to buy. But importantly, next quarter, they're only increasing the bond supply by 10 billion. 3 months ago when you had me on, they increased bond supply for this quarter by 160 billion, and that caused the S&P to fall 8%, 10-year yields rise 100 basis points. And so today, the supply is still heavy, but the rate of change has gone from 160 billion to only 10 billion. And asset prices have cheapened dramatically. And so given that combination of there's still plenty of supply, but less supply, and very cheap asset prices, I think assets are cheap now, and assets can rally in maybe a false dawn through year end. But, that's sort of the way I put together the supply issue.
So so you're long stocks, and in terms of being long bonds, is it time to go long duration at this point? Or do you see value? Do you see, a move higher in all parts of the curve?
Yeah, so actually, the thing I find most interesting is the rally in the 2-year. That's the one that didn't make sense to me. But in terms of long duration, I was short 30-year bonds. I covered them right on the open. And then they've rallied 15 basis points or so. And I think they have another 15 to 20 basis points to go. So I do think the 30-year is interesting. The 2-year rallying doesn't make a lot of sense to me for many of the reasons you all mentioned, which is if bonds and long-term bonds and stocks both rally, the Fed's going to have to hike more, and that's going to hit the 2-year. So I think the 2-year rallying is the most odd bit of this day today. Powell was hawkish. The QRA relieved some of the pressure on long-term assets, and yet the 2-year rallied such that there's about 95 basis points of cuts priced into 2024, and the Fed only expects 50.
Why did you think Powell was hawkish? We just had Steve Leisman on, who, endured the whole press conference live and in person, and he walked away with a dovish message.
Yeah, I think
Okay, I think that's sufficient for now. So I think it's pretty cool to be able to kind of read everybody's kind of interpretation, because there's no right or wrong answer to the interpretation of some of these things that kind of go on. But one thing I did want to share is also just kind of what's been observed at the actual markets, right? You can always kind of interpret what you want with some of these things and what these people share. But this is what actually showed up. This is the last 5 days of the 10-year Treasury yield. As I remember, there was a lot of pain going in the end of last week, and we kind of opened up a little bit flat for the beginning of the week, and we've had some earnings, some up, some down, but we've been kind of hovering around that 4.85 to 4.9% yield on the 10-year Treasury. And you can kind of see the middle of the day today, as soon as the announcement kind of came in, the things are kind of moving into the opposite direction, where we're down 0.08% just this time today specifically. So it's kind of cool to be able to see, how quickly things kind of move. We opened up. I think a lot of people were anticipating the move in the one direction. And then as soon as it kind of came in, that news came in about 2:30. Jerome Powell started speaking. You could see how it kind of dropped off the latter half of the day, going from kind of 4.8, 4.82, all the way down to where we are at 4.7, and kind of persisting into the evening session here. So really kind of cool to be able to see what's going on with that. But I did see a little bit of a request for something in the chat. So let's just take a quick session looking at this. It's very important.
Okay, turn. I don't think we can turn anymore.
I just don't think it's gonna fit.
Oh yeah, cartwheel. Come on.
This is
Up,
crucial
up, up.
economic news.
Yes. Here we go. Pivot. 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 Shut up. Shut up. Shut up.
Now, of course, we have the late Matthew Perry in there. Very sad news earlier this week that he unfortunately passed away. But it is kind of cool to be able to see these things happen real time. And of course, people having interest in this. My guy, SG, I pulled it up because you wrote it. I didn't actually think about that until you said it. So shout out to my boy, SG, who gave me that thought in the chat. But yeah, it's kind of cool to be able to see these things real time. And of course, everyone has their opinions as to what's truly happening. Without the laugh track, it wasn't funny at all. I thought it was good, man. I never watched it when I was growing up. I was too young. I grew up I was born 91, so a little bit too young to be able to understand a lot what was going on with Friends. But I watched it afterwards. You know, I think when I kind of graduated from college and started working, I guess at UDoc, and watched, I think, a lot of the series. I don't know if it was all on Netflix or what, but I thought it was good. But anyway, cool to be able to see. Another piece of news coming out is specifically around Disney getting to basically buy the remaining 30% or so of Hulu. With that, I think there's a discrepancy into what the price is. I think what ends up happening is, and I don't know the specifics on this, CNBC parent company Comcast has a valuation, or will be working with a bank to be able to come up with a valuation of Hulu. Disney themselves, who owns a majority stake in Hulu at the moment, will also come up with a majority ownership, or sorry, not majority ownership, but a valuation for the entirety of Hulu themselves, of which then Disney is obligated to pay at a minimum, I think, $8.5 billion to acquire the remaining portion of Hulu from Comcast, to which I think it'll give them a 90-ish% ownership in the company. And so with that, I think the cool thing is that if they're coming to an amicable term of, let's just say, $30 billion and $40 billion, they'll just meet in the middle and have it be $35 billion. If not, they might end up having a mutually agreed third-party bank decide and not necessarily come up with their own valuation, but look at the work of, say, the Comcast bankers as well as the Disney bankers, and then come up with their own interpretation in between the two. And then obviously whichever one is closer will then be the one. I heard an example on CNBC earlier talking that if it was, say, between 30 billion and 39.5 billion, then they would take the difference between the two and not necessarily use the 30 billion and 50 billion that potentially Comcast might be coming up with. So let's just take a quick gander and listen about what has to happen for Disney.
That's right. The sale of Comcast's stake in Hulu to Disney is moving forward as expected. Comcast is exercising its right under the put-call agreement that they had. Disney then issuing a press release and filing an 8K confirming that it is moving forward in buying the 33% in Hulu that it does not yet own. By December 1st, Disney saying it will pay its percentage of the floor value, $27.5 million, minus capital contributions, which it has made. So Disney then confirming it will pay $8.61 billion and that will happen by December 1st. In the meantime, the companies will continue their negotiation about the additional amount that Disney could end up paying, the premium that they decide that the two companies are going to negotiate, the premium they agree upon to that floor value that was set years ago. So we see this is all moving forward as expected. They say while the timing of the appraisal process is uncertain, they anticipate it should be completed during the 2024 calendar year.
A third kid? What if she likes playing golf? It's expensive.
That it's a good piece to look at, because I know on the 8th next week we'll be actually reviewing Disney earnings. I know Chris is a potential holder in that. I'm not sure if he still holds his shares. I have 50 odd shares in my Roth IRA that I've had for dozens of years, and I always regret not selling them in the 190s. I thought for some reason somehow to go to 250 and 300, just like Netflix did. But I never really truly did the due diligence. But it wasn't big enough a position for me to really move the dial either way. But I wish I had kind of done a little bit more due diligence back then. I was still so bullish about Disney Plus and the long-term prospects of it that I just assumed the stock would never stop growing. But here we are. But I think that with Hulu, I know Chris kind of alluded this to a little bit, and then we'll get into the actual discussion around PayPal. With Hulu specifically, that's a piece that I think is driving a lot of potential ownership. That's actually a significant portion of the streaming viewers that Disney actually owns. And with that, I think you have a lot of ability to expand internationally, which I think they've been putting on hold, as Chris alluded to last time we kind of discussed it. And I think with that, you'll end up seeing a lot longer of returns associated with it. I think that you'll also see some ability to make some better value choices associated with Hulu in the long term. And so with that, I think the economic value of that will grow into the $50 to $60 billion range in short order once it's fully owned by one independent hub. I think that that's just the nature of the game, especially if you're competitors and you don't own things very mutually. I think that it was always known, as you kind of heard in that news segment there, you always heard that Comcast wasn't really going to try to pony up to get a whole ownership of Hulu. So that being said, you could hear they were talking about $29 billion or so worth of total value, of which they're going to have to pay for 30% of that. And obviously, that's closer to $10 billion you're paying for 30% of $29.5 billion. And you can hear they're only paying 8.6. And a lot of that has to do with what Chris was talking about. They're withholding some of the capital contributions, meaning Comcast to Disney. And so with that, the Disney parties are able to hold that over Comcast's head and say not pay that portion of it. So I'm curious to see where we end up. I'm sure we'll be talking about it a lot more within the next week or so as we have the Disney earnings coming in next week. Just as well, might as well, before we get into the discussion of the hour, which I thought I listened to Tanner's brief talk about the earnings report. I listened to Jeremy a little bit as well about PayPal. I think it's kind of cool to just take a step off and look again once at our friend Enphase. Now, if you guys remember on Cashflow Chronicles number 3 or 4, we discussed very quickly about why I think it was titled Matt bought all of Enphase or something like that. And I think one of the things that we're now seeing is a lot of what I discussed in that continues to remain true. Did I foresee it being down this bad? I'm just going to be wholly honest with you guys. I did not. But what I did see was flattening revenue curves from 4Q, 1Q, and 2Q, where before, when we were looking at Enphase and listening to Carlos and Vitaly talk so highly of the company, we continue to see this large revenue growth year over year, quarter after quarter. And what I saw was something that was a little scary, something different comparatively to what Carlos and Vitaly were describing, which is this continuous growth within the solar sector. And what I observed was a flat piece of growth for 3 quarters in a row, which was very unlike what I was kind of seeing at Enphase. And so my fear was exactly what kind of happened. You had continued either flattening or decrease in revenue. And at the time, I think I did it in midsummer, as we've kind of been doing this now for 4 or 5 months now. So this is only episode 3 or 4 of Cashflow Chronicles. We saw that the price to earnings on the company at the time, when it still had higher revenue, higher net income, was around 22x earnings. And so now that you're cutting revenue and you're cutting potential net income going into the 3rd and 4th quarter, that obviously is going to take a huge hit, right? That price to earnings, even if you were to hold that 22 price to earnings, obviously you're going to have to take a hit on the share price because the earnings is going down. So that means obviously in turn that the price of the stock has to go down. So even independently as to whether or not the multiple shrinks, contracts, grows, the company share price has to go down. And it's unfortunate for people that unfortunately didn't really foresee that. They just assume that solar is going to be the savior. I'm more of a long-term believer that community solar, just like what we have today. You don't, when you need oil, you don't go out to your backyard and start drilling. You pay somebody at the gas pump to get your oil to the gas pump for you, or your petrol to the gas pump for you. Just like your natural gas, you're not going to go find some cow's butt to go pull the natural gas out of. You have a line hooked up to a community, and that line is used from a utility company and sent directly to your house. I think in the long term, it's going to be the same way with solar. Not everyone's going to have solar panels on their roofs. I think that, yes, solar will be a huge piece, and wind will be a huge piece of the energy infrastructure going in to the 2030s and 2040s, not just the United States, but worldwide. But what I think is going to happen is you're going to continue to see companies like Berkshire Hathaway Energy, NextEra Energy, and all these other utility companies transition, get their net zero targets in place, and have community solar panels. What a crazy thought. Rather than you having to unfortunately deal with it yourself, you'll end up doing it. And I know there will be the rare and few and far between people that want to do their own solar because they want to cut it and nip it in the bud. But I just think it's going to be more advantageous in the long term, instead of having to pay a premium, say 30% or 40% overhead to whoever's going to install these things, to just go with the community. And I think energy is so cheap these days that you have that opportunity, unless you're well off and you're in the top 10% of wealth earners in the United States. I think that bottom 50% and that other 40% that are below the top 10% are just going to have to go with the community. And I think this is how it's going to be. And I feel like, to be honest with you, that's how it's always been done for electricity over the last century or so. Like I said, you don't see people going out drilling oil wells in their backyard when they need oil, right? So I think, unless you're here in Texas, maybe it's a different story, but or you're out where TJ lives. But just a thought, and I think with that, you see a lot of impacts as well in a company called Solar Edge, which is down as well today, pretty significantly after hours, about 19 or so %. And so you're just continuing to see these companies both down 70 to 80% for the year, which is pretty crazy all in all. What I do want to transition to is a good company that I think a lot of people in the community truly love, but I still am, for some reason, short-term bearish on the company. It's up 4% after hours after the earnings report. I will say this new guy at the head of PayPal sounds pretty legit. And like I said, I'm not a big proponent of PayPal. I think it's an elderly-ish or older technology. Obviously, if it was that revolutionary, Elon would still have a hold of it, but instead he sold it, took his money, and moved elsewhere onto something like SpaceX, Tesla, and a few other companies as well. So in my opinion, it's kind of a company that's in its maturity. But with that, I would say the price to earnings multiple on this thing, if you were to just look, and we'll get into the earnings in a second, because I haven't really deep dive. I just listened to the conference call. I didn't really listen too much to the numbers because I wanted to preserve. So first and foremost, the CEO talking was very bullish for me. He seemed extremely confident. He's going to make sure that they focus on returning the company back to growth, getting a lot of the OpEx out of costs, which obviously is going to drive bottom line net income growth. But also, I think one of the cool things is that I think this company, if you kickstart growth a good bit and you start to sell off some of the old mature assets that might not necessarily be core towards the company's long-term visions, they mentioned that as well, selling some stuff to UPS and getting a premium for it compared to what they bought it for. A lot of these other small things that are kind of distracting, and you streamline the amount of people in the company, just like what Elon did with Twitter, frankly. You're going to hopefully kickstart a new culture and a new wave of innovation at the company, which obviously is going to drive bottom line growth. And if you're coming from a space where you have a price to earnings below 10x, I think that there's nothing wrong with it. Hot Chris, my guy.
My bad, man. I was like, you know what? I'll get a little cat napkin between our financial and Chronicles. And I'm still mostly recovering. I just passed after the way it comes home from work and she's like, she wants
Are you coming to? Yeah, you're coming across choppy to me as well. But I think what you said was you wanted to take a little cat nap, and yeah, not sure why it's coming across. Yeah, very good. Give you a second to hear a lot, but we talked a little bit about JPOW. We talked about Disney, which I want to get your thoughts about. I don't know if you saw any of the CNBC stuff coming today. They're actually starting to get into negotiations about the $30-odd billion valuation of actually buying. And I know it's going to be something we're going to be talking about a lot over the next week, considering earnings for Disney is next week. Actually curious, do you still own shares or do you just own options on Disney?
I have options. I have options on Disney. Yeah. Some long dated leaps on Disney. So basically the story behind all of this, especially when it comes to Disney, is that the story is actually more about the transition from direct to consumer rather than what everyone is talking about, this going woke. I mean, that has something to do with it too. So don't think it's not. I think it's more important that we look at this transition from watching your traditional linear TV to DTC, and every other major media company is doing pretty much the same thing. Everyone had a different channel at some point. They would lease their content to the cable providers, to the dish, to the satellite dish providers, and everyone would just watch TV from there. If you remember from the 1990s all the way to like about 5 years ago, that was the most widespread way to watch TV shows. Of course, Netflix came in, changed the whole business model up, and were able to basically provide cord cutters with this opportunity to actually get rid of their cable subscription. So usually when you got a cable subscription, it was like, like $80, $100, whatever. And each of the people who owned some of the channels on that cable subscription, whether you watch the TV show or not, they ended up getting a little bit of a cut from that $80. In which case, Disney would get a few cuts from that. So, like example is when you watch ESPN. ESPN is a Disney product that you would end up getting. Disney Channel, Disney, Disney Tunes. Then they had an acquisition of Fox, so a lot of the Fox assets would be owned by Disney. So all these things added to their linear offering. The key, though, is that linear is dying, right? Everyone is switching away from traditional cable, and instead everyone's focusing their attention more on direct to consumer. So you're basically focusing on the product itself and the platform itself. So everyone is going their own way, So if you look at all the major media companies like HBO, they have their own thing. Comcast, which owns Peacock, so that's a separate one. Disney has its own thing, which is Disney Plus. It also has Hulu and it has ESPN. The key to Disney's acquisition of that last piece of Hulu was that Hulu is this major streaming network. There's I think like almost 40 million people that use it. But basically, according to the deal that was negotiated in 2000, not 2000, like 2020, before the acquisition of Fox, one of the regulatory requirements was that in the future Disney could. Well, I don't know if it was a regulatory thing or it was just part of the deal, but I think it was just part of the deal. 5 years from that date, each one had an option to exercise that sale of that last piece of Hulu, that 33% of Hulu. So Disney had the option to basically call the option. So basically say that, hey, I want you out. I want to buy you out. And Comcast had the ability to do the opposite, which is they had a put option basically and said that they want Disney to buy them out. And so basically it was a negotiated deal. Now, the valuation is the most difficult part about the whole thing because Comcast would love to get the valuation of Hulu to be like $100 billion, right? Disney's like, no, wait a second. No, your floor price is what we're going to give you, not anything more than that. And the floor plan, according to this, was only about like $9 billion, which is what Hulu was worth at the time, which is around 28 billion. Now it's been 5 years. Of course, there's been user growth and everything else. So a lot of what Comcast is saying hold on one second. Sorry. My Bluetooth is just acting up. Okay. So a lot of what Comcast is saying is, hey, we want more money. Disney's saying, no, we're not going to give it to you. So right now they invited two different investment bankers, two investment banking companies to basically create a valuation of Disney. I mean, of Hulu, that third piece of it. And based on that, Disney and Comcast will settle and get the deal done. So it's a combination of JP Morgan, which is representing Disney, and Morgan Stanley, which is representing Comcast. And so each side right now is trying to create an independent valuation. So according to the arbitration, to the deal, if there is a discrepancy of, I think, more than like 10% or something like that, then they'll get a third investment bank involved, in which case then that'll be like the averaging out there. Other than that, they'll just go based on what Morgan and JP Morgan and Morgan Stanley come up with and use that as the focal point to end the negotiation and close the deal out. But pretty much this will allow Disney to finally have 100% ownership of Hulu. And I think that's one of the keys to Disney's continued expansion and growth, in that they want to be able to, create a more unified platform. Disney is also taking a big page out of Netflix's playbook when it comes to monetization of OTC. So Netflix for longest time, of course, was not making that much money. And now they're actually making money hand over fist. Now, what are some of the things that really changed that made that happen? And number one is, they started cracking down on password sharing. So that forced everyone to really increase the number of subscribers. Disney's been really lax on that. Another thing was also having an ad-supported tier. So, consumers at the end of the day, we want to get the best price possible for a service. Now, not everyone wants to pay, for a service they don't use. But if it's a very small amount and they just have to watch a couple of commercials, a lot of people are okay with that. And so if you combine digital advertising and targeting plus subscriptions, I think Disney has a way to get to DTC profitability. If they get there, that means that the stock is going to be much, much higher than what it is today. So I think the thesis will eventually play out. It's going to take some time. It's nothing that's going to happen overnight. The valuation of Disney is severely, in my opinion, misunderstood right now. Right now, the company is pretty much valued just for their parks and recreation business, and that's it. There's no the linear and DTC business aren't even factors in the determination of their current market cap. So I'd say that is the key to watch out for with Disney. And yeah, it's just monetizing. Sorry, it was a long.
No, you're good. You're good. I think it's going to be really interesting to see Disney come through next week, because like you kind of alluded to, it's kind of funny when everyone was like, oh, Netflix are here. And it's like, the best thing that could have ever happened to a lot of these companies is cord cutting, because now they're able to get all the margin directly to themselves and also control all their content, versus before they'd have to put it on somebody's network or, and so there's that whole political aspect of it. But now they're able to kind of charge an arm and a leg, like YouTube TV, even who isn't even really creating their own independent content. As far as I'm aware, they're just using us to kind of create content and then make sure that they have a premium system, so that way they can utilize other people's content. I mean, they're charging God knows how much a month. I mean, it's pretty crazy, where people used to just be able to have cable and get a couple channels and then only pay $30 to $40 a month and get a whole bunch of other channels. It's really got to the place where now you have to subscribe to Amazon Prime, and you have to subscribe to Netflix and Hulu and Disney and Peacock and Paramount and all these different companies. It's kind of like, who's the real winner here is, I guess, on anybody that has content in their library to kind of continue down that sort of path. But neither here nor there. We'll kind of discuss the Disney piece as time goes on next week, unless you wanted to bring up one last thing for Disney.
Yeah, I just wanted to just show one thing really quickly. So this is Disney's overall revenue going back, and it's on a TTM basis. But one of the things that you can see is that it's not like Disney has a problem with revenue, because revenue is still increasing pretty regularly, mainly because a lot of content is, a lot of user spending is still on Disney and Disney products and Disney X, Y, and Z. The problem with them and the reason why they're down so much is this right here, which is their operating income. So if you look at their operating income prior to like 2018, they had a lot of blockbuster movies, but also they didn't have that giant Fox acquisition that was like an albatross around their neck, and also COVID. So if you look at COVID, really dragged them down, and they've been able to recover their operating income pretty nicely, but it's nowhere near what they were at the peaks in 2018. I think this will eventually change. I think this right here will get back to a point where it's somewhere around here again. I just can't tell you exactly when that's going to happen. I think this value, the DTC part of their business is like the giant X factor in all of this, but it's something that I trust management to be able to, change up their business and get to a point where they are back to normal again. It's going to take some time. Just don't get me wrong. It's nothing that's going to happen overnight, but in terms of operating income, they're getting back there again. And last quarter, they had some phenomenal operating income growth. So, yeah.
My question is for you, Chris. Do you think that's just the drag on the company really just focusing on content creation within Disney Plus, where, obviously you kind of mentioned twofold. End of the Marvel series was coming out in 2018, 2019. So they had so much revenue coming from that, coupled with, the cruise lines obviously doing well, the parks doing really well. All that got slashed, obviously, with the pandemic. But then also during the pandemic, you had the release of Disney Plus, which obviously is going to put a huge drag on operating cash flow associated with the business as you kind of unroll this thing. Just like Netflix had, just like anybody else has kind of seen this large drag on operating income until, you get it fully self-sustaining, and to the point where it's actually generating a pretty positive cash flow for the organization. So do you think that, because we're only 3.5 years in, to actually it's probably only closer to 3 years. I don't know. I'm trying to remember if Disney Plus dropped in 2019 or 2020. But it was around this time.
2019.
Was it 2019? Okay, so we're 4 years into this journey then. So, I feel like Netflix, it took them a good, 8 years or so, maybe even longer, before streaming even started to generate some positive income for the company. And I need to go back and do more due diligence on that. But if you were to remove the operating expenditures associated with Disney Plus, I feel like the company would probably be in a better valuation piece. But I think that's so short-sighted, knowing that if you have something that operates as well as Netflix does, couple that with Disney parks, couple that with the cruise lines, and couple that with merchandise, it doesn't make sense to me why this isn't valued as well as a Netflix plus $50 to $100 billion in terms of market cap. But that's something that we can kind of revisit as we move into next year, because this used to be a $200 billion, $150 to $200 billion company, if I remember correctly. And I don't remember what it's valued at right now, but I know it's probably a ghost of its former self. But I did want to hop into PayPal. I don't know I know you said you didn't watch or really look into the PayPal earnings during Finance Junkies. I'm not sure if you had the opportunity to do any due diligence between now and then on PayPal or not.
Yeah, not yet. Not yet. Yeah.
So let's just hop into it, man. Unless you have anything else you want to add to about the rate hikes or the lack thereof from Uncle Jerome.
Yeah, I think we're pretty much at the end of the rate tightening cycle. I was listening to the conference call pretty intently, and they left the window open for further rate hikes, but I don't think they're necessary. And I think that Jerome was trying to just make sure that he was communicating that very effectively, saying, look, we think we're done with policy tightening requirements, and the only thing that's necessary now is just rolling down that balance sheet. That's enough of an effect to keep going. So I think they're pretty much done with raising rates. Will they stop reducing the balance sheet? No, they're going to keep going with that. The balance sheet reduction is just a part of, how they're going to keep the tightening cycle on. And then on top of it, they actually admitted that there were lagging indicators that do need to catch up, which means that any further rate tightening today would only add to the problem tomorrow, in which case next year or the year after that, they put the economy so far into a recession that they'd have to come in and try to rescue them. And they don't want that. The last thing the Fed wants to do is create an existential crisis that requires them to start cutting rates really fast and then at the same time, start printing money again. So this runoff in assets has been a good thing for them. And hopefully it just keeps it up. I think at the same time, I'd say right now, just based on my experience, like it's a good time to start looking at value-based companies that are currently trading at significant discounts to their historical norms, mainly because of the leverage that they have on the balance sheet. So I think what we're going to see, and the theme that I'm using as an investment, in my opinion, for the next probably 2-3 years, is the great deleveraging cycle among corporate borrowers. So there was a lot of leverage that was borrowed during COVID to see, businesses through, but they also generate significant amount of cash flows. So if a company is able to maintain that cash flow, it has a pretty recession-proof like history of dealing with the recessions, just come and go, and be able to reduce down their debt. That means that, they could be the next winners for the decade or two, which right now, some of them are trading at like literally 13, 14-year lows, which makes no sense to me considering how strong some of the businesses are, how much capital that they have, how ingrained they are. So like the examples that I would give is like AMT and CCI, like American Tower. These are not things that you can just replace overnight. They require a lot of capital to be expended. Same thing with Crown Castle. So a lot of these capital investments were made when things were a lot cheaper, and a lot of that shareholder value is still there. It's just people have really not been a fan of their business model which relies on a lot of debt. And as we start to go into the future, we're going to see them utilize that additional cash flow that they get to pay off debt. And if they pay off debt, that means that leaves more value for equity holders, So, yeah.
Now, we didn't, Crown Castle specifically, I know it's a fan favorite of yours fairly recently. They were put it on the 19th. We didn't talk about them much, but maybe on an off night, we could always go back and look. But I know you've kind of been preaching this, and I kind of alluded to it a little bit earlier as well. We went through some of the CNBC discussions about people saying, the end is near with respect to, these rate hikes, and we're now starting to see the end of the tunnel again, which I was kind of expecting, hopefully, 3-4 months ago. That did not happen. We kind of went into this place where the Fed kind of doubled down and said, nope, we're not done. And that, kind of got to when we were at the 4.5% federal funds rate, kind of there. I was expecting, okay, we're done. And it's like, nope, we're not done yet. 2.0 means 2.0. Now they're kind of just starting to take a little bit of a step back. Hey, TJ, thank you for the super chat, man. Much appreciated.
Thanks,
Glad to see you again. I think the thing that I was also thinking about, and they alluded to, which Tom Lee mentioned on CNBC, was specifically the fact that they're kind of using more normalized trends that are actually like occurring today, which I thought was kind of a pivot. You and I always talked about how they're always 3 or 4 months behind with some of the data that they're using. And so it seemed like today specifically they were focusing on what's going on in the Middle East, what kind of wars are potentially starting there, how that might play an impact on economics or commodity prices in the United States. And so with that's kind of like more day-to-day sort of impacts that the Fed is now looking at, which is very interesting compared to what the Fed normally looks at, which is the markets can do whatever they want. The news can say whatever they want, but in reality, we're looking at the data, which is always 3-4 months behind. So it's kind of a pivot in that respect. And it was cool to see that maybe the Fed is kind of being a little bit less strict these days. And so I think the 10-year bond obviously showed that. And a few of the equity prices showed that as well. But unless you have any other thoughts, we can hop on over to PayPal.
Yeah, one last thing. I just wanted to show the inflation, depending on which country you're looking at, is actually slowing down significantly. I'll point you to one of the more Euro-focused countries, because I think that is a good highlight. So this is right now the European country, the Netherlands, or the Dutch, depends on who you talk to. The Dutch inflation's actually gone down so much that now they've actually entered into deflation. See that? Kind of nuts, right? Considering where they were in January. January, they almost had 10% inflation. Now they're down to like -4. This, I think, is the future for us here in the US. I think a lot of the Netherlands is a little bit more exposed to like energy prices, which makes them a little bit more sensitive to that. But for the most part, I think this is where we're headed. And if we do get into a point where deflation starts to become a thing where we get closer and closer to it, we could see a dramatic rise in people chasing yields. And so things like instruments like the TLT are going to get bought up like crazy. So just as a FYI, which is the long bond, by the way. So just in case, keep your eye on the CPI numbers pretty closely. I do think that we're probably going to be entering into more of a deflationary scenario in probably Q2, Q3 of 2024. It all depends on our shelter. So if shelter takes a big hit, then we're likely to see that jump in people looking for yields. You know, for me right now, my thesis has always been around AI being this incredibly deflationary force. It's very similar to how internet was for us in the earlier part of the 20th century, right? 21st century. I think right now it's the same thing when it comes to AI. I think there's so many opportunities for productivity boost that AI can give us that overall I think inflation is going to be pretty tempered going forward. So.
Right. Yeah, I just wanted to bring up the TLT. You could see just that last little tick up was just today. It was up 2% right after kind of the feeling on market open that things were going to be going in the right direction. And of course, after Jerome and the notes came out, it started to rally another about percent up after that. So maybe a little bit more, almost 1.5% up after that. So kind of cool to be able to see. I'm curious, considering this thing's down, 16, 20% since the beginning of the year, if this will turn around. And I, looking at it from a 5-year perspective, this obviously was imagined and happened through when you started returning back to zero interest rate policies, a bunch of stimulus. But I mean, the sky's the limit. I mean, it could go back up to over 100 on this bad boy, and in the meantime, collect a pretty healthy dividend yield. But of course, it all is very dependent upon what happens with the short-term yields. And I think it might be a little bit too early. I think waiting another month or two before, but at the same time, yields just based off of sentiment can go down. But I want to highlight specifically something that somebody had mentioned earlier with respect to the balance sheet reduction. The Fed has not actually sold any of these bonds, right? They're just letting them roll off the balance sheet. They're not actually actively selling. If they were to sell these things, then they would literally kill the market for decades, right? We're talking about trillions, not billions worth of bonds. And so I just want to highlight, they're not selling these things. They're letting them roll off, right? Which means they're buying the 2-year, they're buying the 1 year, they're buying the 13-week, they're buying the 26-week. And instead of rebuying them with the proceeds, just like kind of how they were kind of keeping things flat, as people kind of remembered, we were at $4 trillion or so worth of debt hanging out after, quantitative easing prior to 2018. They started to roll off the balance sheet a little bit there. They're not selling anything. They're rolling it off. They're letting the bonds mature. And then instead of using the proceeds to buy back more to kind of keep the assets on the balance sheet, they're just letting the money go, right? They're letting it go back into circulation. So it's interesting that people think that just because they're letting things roll off that they're selling. No, it's just $100 billion worth, believe it or not, of treasuries mature every single month. And that's just based off the fact that that's about how much they were buying. They were buying $80 to $100 billion worth of treasuries a month in the worst of times during the pandemic. And so now instead of buying them, they're letting them just roll off. And I just wanted to correct that because I don't want people to continue to believe that they're actually selling these things. They're just letting them roll off. But Chris, anything else before we maybe hop over to PayPal?
Yeah, just I'm trying to make sure that it's hard to cover some of the comments like Azure Blues, like Crown Castle's quarterly revenue growth year over year is negative. Yeah, you know what? A lot of that stuff is correct. That the numbers don't look compelling, but you have to this is where you have to do real due diligence and understand why there is a negative quarter over quarter, I mean a year over year growth rate just for that one quarter. And once you do the DD, you can totally understand what is actually going on. I'm not going to sit here and try to explain everything because might take us an entire hour, but eventually you guys will see the changes that are happening, and maybe we could do like a dedicated Crown Castle episode actually, and same thing with like an American Tower episode where we kind of discuss what the bull case behind these companies is.
Yeah, I think we have a lull after Rocket Lab next week on Wednesday, which I think also coincides with Disney. I think we have an empty spot on Thursday. So I don't think, unless anybody else comes up with anything or I'm missing anything, it could be something that we discuss next Thursday. Monday, I think, is reserved for Dutch Bro, or sorry, not Monday. Tuesday is reserved for Dutch Bros, and there's something else. And also tomorrow, do you know if AbCellera reports before their market opens or after?
I think after.
Okay, so we'll have obviously Palantir to discuss, AbCellera, and the big old Apple. I'm sure many people will be discussing Apple, but I know a lot of people have been poking me about your thoughts on AbCellera because they know that you've bought some shares, you threw away the password, and don't even know what the password is. I think that you had
that's somewhere. I have it written down somewhere.
Yeah, you hid it in a safe, you forgot the safe combination, something like that. You mentioned it on the channel before.
Yeah.
I'm just fucking around, but okay, well, appreciate that. And I'm curious. I listened to Tanner, a Tanner stream, and also Jeremy's stream on Twitch a little bit for the PayPal. You didn't listen to it, I don't think. The new CEO, dude. I didn't really listen to the numbers, but I listened to what he was saying with respect. I didn't really listen to the new CFO who he brought in, but I listened to his introduction. And man, this guy had some balls. Like I was impressed. I don't get intimidated by a lot of people and impressed by a lot of people these days because I've been listening to a lot of conference calls and I've heard people bullshit through their teeth before. But this guy seems like he's one step removed from what Elon is trying to do, or what Elon did at Twitter. Like he's just like, we're coming in. There's so much operating expenditures going on. There's so much so much potential in this thing. And so I'm really curious. You know, the stock is up about 4 or 5% after hours. After listening to this guy speak, I think everyone was kind of waiting. And once they heard the words that were coming out of his mouth, I can kind of understand why things were trending in the right direction for this company. The things that I heard were selling off legacy systems, selling off, things that are not core assets, kicking back to growth, and then seeing things simple like, now let's just hop into some of these numbers and do some quick notes here. Like, what's the one thing that I saw? It was the earnings per growth. So $5 non-GAAP EPS. So of course that's with share-based compensation and stuff of the like. But even if you just take that for what it is, the company's trading at $54. So if you think about it in this perspective, it's trading at like 11x fiscal year 23 earnings, and it grew 21% year over year, which is pretty impressive. So if you start to think about what they're going to be doing in potentially next year, let's just say they grow this another 10, 20% next year, you're looking at $5.50, $6 on non-GAAP, or even if you do a GAAP basis, you're looking at, let's say, $4.25 to $4.50 in GAAP EPS. I mean, you're looking at a company that's pretty dang cheap, is throwing off a decent amount of cash, is buying about 1.5 billion shares every quarter. It's impressive. My thing is, though, is like, are they actually going to be able to grow that quickly and actually, I guess, grow revenue to the point where it's not necessarily just based off of share purchases and OpEx cuts and stuff like that? Are they actually going to be able to kickstart revenue growth again? And the reason why I ask that is you can kind of see some of these transaction volumes that are kind of going on here, and they're all in all somewhat flat, right? Over the past year or so, yes, it goes up a little bit, comes down a little bit, of course, increases a little bit in Christmas time frame and the end of Q3. But I mean, year over year, technically it went down for total transaction volume. So you kind of see these sort of trends is like, well, what exactly do they need to do to kickstart this company back into the right direction and get themselves into a place where they're able to kind of compete with some of these other growing fintech companies like SoFi or Square or Block, whatever the heck you want to call it these days. And that's kind of my fear is like, I get it. From a valuation perspective, this thing throws off some serious cash, but is it going to be fitting in a place where, unless there's big share buybacks or there's dividends that are going to be distributed, like what's the true point of owning this company if in the long term, it's not going to grow earnings per share, not by buybacks, but actually grow earnings based off of revenue growth?
Yeah.
Thoughts?
Yeah, I mean, it's all about figuring out how to monetize their core products, right? If they can do it and substantially reduce their OpEx, then they can grow their way into a much higher valuation. So, like I said, I haven't done nearly the amount of DD that I should have yet on PayPal. So once I do that, I'll get back to you. I was waiting for this CEO to really drop some information on what his future plans are in terms of like business development before really like adding or taking away from my position that I already have. Because I think this is one of the things that always happens when you have these new CEOs take over, they are the X factor in determining where the future of this company goes, not the numbers. The numbers today are almost irrelevant if the CEO changes things up and, doesn't figure out how to make more money or less money or whatever. So the key right now is just waiting on this guy. And so it's becoming a little bit more clear. They also changed up their CFO from what I just read in passing, which I'm also going to like deep dive into her background as well, because I think the CEO controls the guidance of the company. The CFO controls the purse strings. And so you need strong candidates for both in order to really make the companies work to the most efficient degree possible. So, I just had a quick glance over her profile. She has a background with Ernst & Young and also with GE. So that'll be a very interesting read from my part. But like I said, I'm going to be really, really deep diving into PayPal's new management, because I think if there is going to be a lot of future alpha, that's where it's going to be coming from. Wait, go back to that slide, that Meta one. Strengthening our business relationship drive for growth since PayPal and Meta have enjoyed collaborating. Blah, 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 blah. When Meta engaged, they engage PayPal. Okay. See, this is the kind of stuff that really should get people like interested, because if you look at Meta, right? Meta, it has its reach into almost 3.5 billion people, right? Via its social media products. Maybe PayPal could be an acquisition target for something like Meta, because Meta probably already uses so much of their transaction history. It could be, like I said, it could be something to just keep in mind. And also it could be an exclusive provider as well. So it's worth taking a look at.
Yeah. And I think that there is some good things to the company as well. I mean, it does ease value of commerce amongst people. I think that especially in a world where we're still mostly cash, it's hard to say that when you're living in the West and everything is kind of digitalized for the most part, but there are still parts of the world that is heavily cash based. I think that utilizing stuff like this and being able to collaborate in a further e-commerce driven world, digital world, this company does have a place to fit into that.
Can you go back to that other slide real quick? Sorry.
Capital allocation there.
Yeah. Acquisition, strategic investments. Okay. So that's good that they're focusing more on more on shareholder value return. That's good. That those share repurchases, those are significant amounts of capital that's being spent there, and it looks like they're just constantly increasing it. So this is a very similar thing to what we saw with AutoZone. Remember with the amount of shares as they buy those back, that raises your EPS. And if they're able to maintain their cash flows over a long period of time, then that's good. Announced divestiture of Happy Returns for 465 and proceeds enabled. Yeah, like I said, this is a lot of math.
It's a lot.
Yeah.
But like you said, I mean, like you said, even if they're able to continue this 5% year over year, I mean, they could technically stay flat, and just by buying back shares every single year, decrease their share count by X amount, and with that the price goes up, right? But I think it has to hit some point where it's not decreasing in share price before it actually gets to that point, right? So lots of cool information in here. I'm not going to hold you to talking a lot about it, because you probably have to do some due diligence, but I know a lot of people in the community are really excited about the company, and I personally just, how do I say this lightly? I agree with you more so. I think it could be a takeover target, but I think that for now they're going to be, with the new CEO. I think that they're probably going to go after it for a couple quarters before they truly move to a place where they look to potentially merge or be bought out by somebody.
Well, I'm just saying in terms of valuation that, I'm not saying that they'll get bought out overnight, that no one's actually going to do it. My whole thing is, when it comes to try to determining a floor price for a company, the acquisition price is what I usually do to determine that. Like, so what is the cost of goods? I mean, what is the minimum a company would be willing to pay for PayPal? Because that is where that should be an absolute floor that you can use to basically accumulate or not. So like right now, if revenues are still flat at current cash flow, what should be the valuation should be, and then go based on that. So
yeah. Well, currently the company's trading about $56 billion, which doesn't leave a lot of room to be acquired by, I'd say, most people, but I'm sure some companies might see it as an opportunity. I mean, you think about it, when you have companies like Google, or you have companies like Meta, or even Apple, for example, that have literally dozens of billions of dollars, if not hundreds of billions of dollars on the balance sheet, what's it to them, right? I mean, especially if they're looking for opportunities for further income, or having issues with coming up with their own wallets, right? Remember how Facebook was kind of having those issues after they were trying to come out with Libra and all these different things. It's like, well, if you're continuing to want to go down that cryptocurrency path, I know PayPal is somebody that's trying to get on that. And so if that's the case and they're slightly ahead of the game, it might just be a strategic acquisition for a Meta, like you said, and have immediate access to 3.5 billion people, comparatively to maybe the people that they've been working with in the past. I think it was cool. I mean, think about it. PayPal, Venmo, all these sorts of things are products in which I would say most of the people have used in this chat, the 70 odd people that are watching right now. I think even in the discussion, the CEO said, look, this is a product that everybody is familiar with. 70% of people in the United States that are adults have utilized PayPal in some shape or form in its history. So you think about it, it's like that's pretty widespread. I mean, we're talking about probably close to 150 million people that have used PayPal in the United States. And so if you're able to expand that reach, whether that's through South America, whether that's across the globe, I think that there's an opportunity here. To me, and I guess my question to you is, and then maybe we could leave it there and talk about it another day once we have our ability to sink our teeth into it a little bit more. To me, I would need to see a quarter or two of real action, like you said, with the CEO, and a quarter or two of things kind of moving in the right direction for me to truly feel comfortable owning a company like this. because I think that the thing that bothers me a little bit is what's the long-term vision that's truly going to differentiate them in a very competitive environment with all these other fintech companies. And then two, you know, there's sometimes when CEO transitions just don't favor well for companies, and the company culture doesn't mesh well with it, and so having this outsider kind of come in to kind of work in the company and you know, try to change things up might end up not working well, and it could end up driving a wedge between the old company culture that's kind of been established to where it just doesn't end up working out, and unfortunately it might end in an untimely death, and it just might end up being, I don't want to say scraped for parts, but I don't know. I mean, I don't think the company's going to go bankrupt. There's no way, right, with the amount of cash that it's generating, but it could just flounder and just be one of those companies that doesn't grow all too much and just trades at a, 10 times PE for an extended period of time because people are confused about the long-term strategic endeavors that the company's taking on.
Yeah. Yeah, I'm still a little bit more bullish on them only because of that giant share buyback plus the cash flow generation of the business really helps their EPS. So I like I said, I'll do some more DD on what the company's actually trying to do, but they're cutting back on expenses pretty rapidly from what I'm looking. I'm looking at their balance sheet and all that stuff right now, just doing their DD really quickly off the top of my head. They are flatlining in terms of revenue, which is not good, but it's also not bad. That means that they're not losing a lot of business. What they are doing is they're cutting a lot of expenses. So the expense ratios that I'm looking at are trending downwards. Transactions or credit losses are okay. But man, let me tell you, I'm looking at their charges right here for their administrative positions. Sales and marketing is down significantly. Operating expenses are relatively muted, which is good. That means that profitability is going to be there. And then also those share buybacks are really like taking a big chunk out of their EP. Well, it's helping their EPS significantly.
Yeah.
They don't have a lot of credit losses either, which is nice. Very interesting. Very interesting. I'm gonna have to do, like I said, I'm gonna have to do a lot more research. But yeah, they just, what they need is they need a return to growth mode. Once they get to growth mode again, even a small bit of growth mode will help them like really go up in value. Because the biggest problem is right now is their lack of growth. So they're not going to be valued like a growth company. They're going to be valued like a value company. And if they are valued like a value company, there's still a lot more room downward to go.
Yeah. Cool. All right. Well, I appreciate everybody. I know at one point we had 70 odd people in here, so much appreciated. Chris, for your acknowledgement, we tried doing some work on Twitch today. Just to see. So technically this stream is actually going on Twitter as well as Twitch and YouTube all at once. And so it's just a trial to see what's going on. We actually had a bot, it looked like, it come onto the Twitch and chat on the right-hand side. So as expected, bots are everywhere. But curious as to see, trials for everything. And of course, we continue to grow on YouTube as most. For those of you guys that are new, be sure to follow Chris on all his media sites, social media, on Twitter, Patreon. All those are in the description below. Contemplate whether or not you will be becoming a member of the Money Gang just by becoming a member here on the Matt Money channel. Chris and I will eventually be probably uploading some spot, I guess, clips on a new channel where we hope to grow Cashflow Chronicles for real. Very similar to what Finance Junkies did. And then Chris and I still have a surprise, which him and I need to chat about. So Chris, if you have like 2 or 3 minutes after the stream, we can talk about that briefly, because we will be adding more money to that this month as well in November, and more money every month, actually, as long as Cashflow Chronicles continues to be a thing. So thank you guys, and look forward to talking to you guys tomorrow with Palantir, Accelera, and Apple. Chris, any last words?
No, that's it. Sorry for being late, guys. I gotta.
You need a nap, man.
Reset myself. I need to reset myself a little bit more these days.
Yep.
Yeah.
Cool. Talk to you guys tomorrow.
Later. Take care.